You can have a wildly profitable year on paper and still go completely bankrupt because you simply ran out of cash.
Oh, absolutely. It is the ultimate pain point in business.
We see it all the time, right? Like companies and honestly even seasoned accounting students fall into this dangerous trap of confusing the profit on an income statement with the actual money sitting in the bank.
Yeah, it's a very common trap.
So I want you to think about this. If a business made $80,000 in operating profit, but suddenly reports $161,000 in net cash from its operations, where exactly did all that extra money come from?
That is the big question.
Welcome back to the deep dive. You sent us a fascinating stack of notes and ACCA study materials specifically focused on the IAS 7 statement of cash flows.
Really good materials, too.
Yeah, our mission today is to cut through the accounting jargon and just figure out how to find where a company's money is actually hiding. Today we are covering ACCA's IAS 7 statement of cash flows.
We are indeed.
We will break it into 3 parts, look at a real-world example, and finish with 3 exam tips you can use immediately.
Perfect. To start, let's build our foundation.
Okay.
What is a statement of cash flows, really?
Right.
At its most basic level, a statement of cash flows tracks actual cash receipts as positive numbers and actual cash payments as negative numbers.
That's it.
That is it. It just strips away all the accounting estimates and shows you the raw reality of money moving in and out of a business.
Okay, let's unpack this. It's like, it's the difference between your employment contract and your actual bank account.
Oh, I like that.
Right. Your contract says you make a certain salary for the year, that's your profit.
Exactly.
But your bank account shows what you actually have available to spend after taxes are deducted, after paychecks are delayed, and after your monthly bills hit.
Yes.
So your bank account is your cash flow.
It is. And what's fascinating here is how this is actually done in practice. Well, you might think accountants just log into the corporate bank account and meticulously categorize every single deposit and withdrawal to build this statement.
I mean, that's what I would assume, yeah.
But they don't. Cash flows are almost never tracked directly.
Wait, really?
Instead, they're usually calculated backwards as a balancing figure.
Wait, so they reverse engineer it?
Yep.
So that seems incredibly tedious. I mean, why not just automate the bank feed and isolate the cash transactions directly?
Because a modern company has thousands, sometimes millions of transactions, and bank feeds only show you amounts and dates.
Oh, right.
They don't tell you the purpose of the cash movement in a way that maps cleanly to, complex accounting standards.
That makes sense.
Plus, the business is already meticulously tracking accruals, the promises of money, to build the profit or loss statement.
Ah, okay.
Trying to build a parallel system from scratch, just to track pure cash by category, is a logistical nightmare.
So what do they do instead?
They use a brilliantly simple technique. They take the opening balance of an item on the balance sheet, let's say a liability.
Okay.
They adjust that balance for all the non-cash transactions that happen during the year.
Right.
Once you reconcile those non-cash changes, whatever amount is missing to get you to your actual closing balance.
Yeah.
That missing piece, the balancing figure, reveals the exact cash flow.
Oh, wow. So instead of tracking every drop of water that falls into a bucket, you just measure the bucket at the start, measure it at the end?
Factor in any water that evaporated.
Right. And the difference tells you exactly how much rained down.
Precisely. And if we connect this to the bigger picture, in the real business world, your suppliers do not accept profits as payment.
They definitely do not.
They only accept cash. Understanding cash flow is fundamentally about understanding if a company is actually surviving.
Yeah, you can have all the revenue in the world, but if your customers aren't paying you in cash, you cannot keep the lights on. Which makes it the ultimate test of business acumen. And for anyone preparing for the exam, looking through your notes, there seem to be 2 distinct reasons examiners love this topic so much.
Oh, they love it.
Here's the first.
First, it proves you truly understand the difference between accrual accounting and cash accounting.
Right. Promises versus reality.
Exactly.
Right.
Accrual accounting is built on promises. When a sale is made, it's recorded immediately, even if the cash hasn't arrived.
Okay.
The examiner wants to see if you can strip away those promises and find the reality.
Makes sense. And the second reason?
Second, it strictly tests that balancing figure technique we just mentioned.
Ah.
It forces you to demonstrate that you can systematically strip away non-cash transactions to reveal the hidden cash movements.
Basically, the examiner wants to know if you can act like a financial detective, dusting for fingerprints on a balance sheet to find where the actual money went.
It really does completely separate the rote memorizers from the people who actually understand the mechanics of how a business survives.
Okay, let's get into those mechanics then. There are 3 parts to this. Let's take them one at a time.
Sounds good.
Part 1, operating activities.
So operating activities represent the day-to-day cash generated by the core business.
The daily grind.
Exactly. And IAS 7 allows you to present this in 2 different ways: the direct method and the indirect method.
Okay, what's the difference?
The direct method is very intuitive. You literally list the cash you receive from customers, and you subtract the cash you paid to suppliers, employees, and for income taxes.
That is straightforward.
It is.
So simply put, operating activities are the cash your core business actually generated.
Correct. But then there's the indirect method,
Mm-hmm.
which is much more common in exams and in the real world.
Okay.
Here, you start with your operating profit, which is full of non-cash accounting items, and you reconcile it backwards.
Oh, like we talked about earlier.
Yes, you adjust it for all the non-cash income and expenses and the changes in working capital to finally arrive at the exact same net cash figure.
But why does IA7 allow 2 entirely different methods? If the direct method is so intuitive, why do companies bother starting with profit and working backwards?
It comes down to data availability, honestly. Gathering cash receipts directly from customers and direct cash payments to suppliers requires highly specific tracking.
Right, which most accounting software isn't optimized for.
Exactly. But the indirect method, it relies on data the company has already audited and finalized for the balance sheet and income statement.
Oh, so you already have the numbers.
You already have your profit figure. You already have your working capital changes. It is far more efficient to just adjust those existing numbers than to build a new reporting system.
Both methods get you to the same place, just via a different road.
Exactly right.
That makes perfect sense. So if operations generate the daily cash, what happens when the company needs a new factory to expand those operations?
Well, that cash has to come from somewhere else.
Which brings us to part 2, investing activities.
Yes. This section relates entirely to non-current assets.
Yeah.
We're talking about the big, long-term stuff.
Like buildings and machinery?
Right. The cash you paid to buy property, plant, and equipment, which we often abbreviate as PPE, or the cash you receive from selling that PPE.
Okay.
It also includes cash inflows from investments, like, dividends you receive from another company, or interest received.
Okay, so this is about the long-term infrastructure of the business.
Yeah.
But here's where it gets really interesting based on the materials you sent over. Let's say you sell a piece of machinery for $2,000 in cash.
Okay.
But on your books, you actually made a $500 profit on that sale because of how the asset was valued.
Right, the accounting profit.
Yeah. So which number goes into the cash flow statement? The profit or the proceeds?
That's a great question.
We will solve that in a second. First, let's hit part 3, financing activities.
All right, so financing activities show how the entity itself is funded. This is your capital structure.
So where the money comes from to begin with.
Exactly. It tracks the cash coming in from new borrowings, like taking on debt, or cash from shareholders when you issue new equity.
And the money going out.
On the flip side, it tracks the cash going out to repay those debts, the interest paid on those borrowings, and the cash dividends paid out to your shareholders.
So if operating is the engine of the car, investing is buying a better engine, and financing is the bank loan you took out to pay for the car.
I love that. And taking that engine analogy a step further, financing is also when you ask your friends to chip in for the car in exchange for a share of ownership.
Right, that is your equity.
Exactly. It cleanly categorizes the entire financial ecosystem of the company.
So to bring that together, every single dollar moving in or out of a business is simply categorized by whether it's used for daily operations, buying long-term assets, or funding the company itself.
And this is exactly where the theory has to meet reality.
Which brings us to a real-world scenario. Looking at the financials you provided for a company called Crombie Co., we need to figure out how much cash they actually paid to buy new property, plant, and equipment during the year.
Okay, let's walk through the numbers deliberately.
Right.
At the start of the year, January 1st, Crombie Co. had PPE with a baseline carrying amount of $10,000.
$10,000.
By the end of the year, December 31st, their PPE carrying amount was $30,000.
Okay, so my initial instinct is to just look at that and say, well, $10,000 up to $30,000, so they just spent $20,000 on new equipment.
And that is exactly where the trap is set. You cannot just look at the difference.
Wait, really? Why not?
We have to adjust for the paper illusions The non-cash movements that happen during the year.
Oh, right. The accounting estimates.
Exactly. Your notes give us three crucial pieces of additional information. First, during the year, there was a depreciation charge of $2,000. Depreciation reduces the value of the PPE on the books, but no cash actually leaves the building.
Right. It's just an accounting expense recognizing wear and tear over time.
Second, there was a revaluation surplus of $6,000,
What does that mean?
meaning the company revalued some of their assets upwards. This increases the PPE balance on the books by $6,000, but again, no actual cash was spent to get that increase.
Oh, so it is just a paper gain.
Exactly. And third, they disposed of some PPE that had a carrying amount of $1,500 that removes value from the balance sheet.
Okay, let's slow down the math and do the financial detective work here.
Let's go.
We start with our baseline opening balance of $10,000.
Right.
Now, let's factor in those paper illusions. We drop $2,000 for depreciation because that lowered the book value.
Yep.
We add the $6,000 for the revaluation surplus because that artificially raised the book value. And we drop the $1,500 for the asset we got rid of.
So 10,000 minus 2,000 plus 6,000 minus 1,500.
Let me think. That gives us a subtotal of $12,500.
So if they hadn't bought any new equipment at all this year, their closing balance should be exactly $12,500.
Yes. But we know their actual closing balance is $30,000.
Right, which raises an important question. How did they get from a subtotal of $12,500 up to an actual finish line of $30,000?
The missing piece.
Yeah.
The balancing figure.
Exactly.
$30,000 minus $12,500 is $17,500.
And that $17,500 is the actual cash paid to buy new PPE. That is your cash outflow for investing activities.
Oh, wow. For our younger listeners early in their accounting journey, think of this as building a foolproof T account or a simple reconciliation working.
Yes, that's a great way to view it.
If you plug in your opening balance at the top, your closing balance at the bottom, and drop all your non-cash movements in the middle, that one missing number is always your cash. It takes the guesswork completely out of the equation.
And for the senior professionals listening, spotting this $17,500 cash drain is absolutely crucial.
Why is that?
Because look at what happened here. The company had a massive $6,000 revaluation surplus.
Right.
A company artificially inflating their asset values on paper with revaluations could be masking massive unsustainable cash expenditures behind the scenes.
Oh, I see.
If you only look at the balance sheet, you see a healthy asset base that tripled in size. It looks fantastic.
But if you do the cash flow reconciliation,
You see a company bleeding cash to buy equipment.
and that right there is exactly what the examiner is testing when they ask about extracting cash flows from balance sheet changes.
Spot on.
They want to see if you can strip away the noise. Oh, and I haven't forgotten our cliffhanger from earlier.
Ah, yes. The asset sale.
Right. The asset they sold had a carrying amount of $1,500, but they sold it for $2,000 in cash, making a $500 profit. How do we treat that?
According to the rules in IAS 7, you strictly separate the reality from the accounting.
Okay.
The actual cash proceeds of $2,000 are shown entirely separately as a positive cash inflow under investing activities.
So what about that profit?
The $500 profit on disposal, that is just a non-cash accounting illusion.
Ah.
So under the indirect method for operating activities, you actually deduct that $500 profit from your starting operating profit to strip it out completely.
Oh, that makes sense. So what does this all mean for the exam itself? Like, what is the single most common mistake people make?
Oh, without a doubt, it's messing up the working capital adjustments in the indirect method.
Really? Messing up the working capital adjustment.
It happens all the time.
Why is that?
Well, there's a fascinating metacognitive reason why our brains fail us here.
I'm intrigued.
In the indirect method, you have to adjust your operating profit for changes in working capital. That means your inventories, trade receivables, and trade payables.
Okay.
Now, imagine a student sees an increase in inventory on the balance sheet.
They see the word increase.
Exactly. Their brain sees the word increase, instinctively associates it with growth and positivity, and assumes it should be added as a positive number to the cash flow.
But they fail to realize that to get more inventory, you had to spend cash.
Yes,
An increase in an asset is actually an unfavorable cash flow. It is a deduction.
exactly. If your inventory goes up, your cash went down to buy it.
Right.
If your trade receivables go up, it means more customers owe you money but haven't paid you yet.
Which is terrible for your cash flow.
You haven't collected the cash. So an increase in receivables is also a deduction.
It's like going grocery shopping. Yes, the amount of food in your pantry just increased, but your wallet is significantly lighter.
That's the perfect way to put it.
Don't tell your accountant you gain money just because you have more cereal boxes.
So here is the simple fix to ensure you never fall into this cognitive trap.
Let's hear it.
For every single movement in working capital, force yourself to ask one question. Did this have a favorable or unfavorable impact on my cash?
Okay. Favorable or unfavorable?
Right. If inventory goes down, it means you sold at favorable impact, add it to profit.
Nice.
If trade receivables go down, it means customers finally paid you favorable impact, add it.
Okay.
If trade payables go up, it means you are delaying paying your suppliers and holding on to your cash, longer favorable impact, add it.
Always ask. Favorable or unfavorable to my cash balance? That one question completely reframes the whole exercise.
It really does.
Okay, we are in the home stretch. Let's give you your exam edge. 3 things. Here's number 1.
Tip number 1, master the balancing figure rule.
Essential.
Always reconcile your opening balance to your closing balance using non-cash changes. The missing piece is always the cash paid or received.
Okay,
Take income taxes from your study notes as another example.
let's do it.
If you had an opening tax liability of $500 and the profit statement showed a new tax charge of $1,000, you owe a subtotal of $1,500.
Makes sense.
But if your closing balance says you only owe $900,
Oh, the missing $600 is the balancing figure? It means you must have paid $600 in cash.
exactly.
Tip number 2, direct versus indirect isolation. Looking through the rules you provided, it is clear that the choice between the direct and indirect method only affects the operating activities section of your statement.
That's right. It is a completely isolated choice.
So whether you use direct or indirect, your investing activities and your financing activities sections will look exactly the same.
Do not let the method confuse the rest of your statement.
And finally, tip number 3.
Tip number 3, non-cash add-backs. When you are using the indirect method, you start with operating profit.
Okay.
You must always remember to add back your non-cash expenses, specifically depreciation and amortization.
Add them back.
Yes. If a company has an $80,000 operating profit, but they had $50,000 in depreciation and $40,000 in amortization, you add those right back to the profit.
Why?
Because that $90,000 in expenses never actually left the building.
At the end of the day, cash flow isn't about counting physical bills. It's about stripping away all the accounting illusions to reveal the actual money left standing.
That's really what it boils down to.
For the younger listeners out there stressing over this exam, I want you to reframe how you look at this. Once you master this reconciliation format, these exam questions turn into simple puzzle solving. You have all the edge pieces, you just have to solve for the middle.
And for the experienced professionals listening, remember that understanding IAS 7 isn't just about passing an exam.
Right.
It's the ultimate lens for cutting through financial noise and seeing the true health and survivability of any business. It shows you the absolute reality.
Which brings us full circle, back to the start of our deep dive. Remember that theoretical company we mentioned with an $80,000 profit, but a massive spike of $161,000 in operating cash?
I do.
You now know exactly where to look. They didn't magic the money out of thin air. They just took their $80,000 profit, added back a massive $90,000 in non-cash depreciation, and got really good at managing their working capital, meaning they collected money from customers faster and paid their suppliers slower.
It's all right there in the statement of cash flows.
Remember, profit is an opinion, but cash is a fact, and the balancing figure is how you find it.
Exactly.
Next time you read a headline about a tech startup celebrating a record year of profitability, don't look at their income statement. Ask yourself, how long until their suppliers come knocking for cash they don't actually have?
That is the ultimate takeaway.
We genuinely want to thank you for joining us on this deep dive. If this helped clear the muddy waters of accounting for you, please follow the show on Spotify and leave us a review. It helps us keep making these for you. Thank you for listening.